Forex trading is more than just numbers and strategies. It's a mental game. You can have the best strategy in the world, but if you don't control your emotions, the market will control you. In this video, we're going to dive into the essential psychology tips for beginners in Forex trading. Stick around, because understanding these could be the difference between success and failure in your trading journey. Tip number 1, master your emotions. The first tip is mastering your emotions. Fear and greed are two of the biggest killers in Forex trading. When the market moves unexpectedly, it's easy to feel overwhelmed by fear of loss or the temptation to chase profits. Instead, have a clear plan before you trade and stick to it, regardless of how you feel in the moment. The goal isn't to eliminate emotions completely, but to manage them. Set stop losses and take profit levels before you enter a trade, and let those boundaries guide your decisions. Tip number 2 is patience. Many beginner traders want to jump into the market and make quick profits, but the reality is, Forex is a waiting game. Often, the best trades come when you've waited for the perfect setup. Rushing into a trade out of boredom or impatience can lead to losses. Tip number 3, accept losses. Accept that losses are a part of trading. Even the best traders in the world lose money. What separates beginners from professionals is how they handle those losses. Instead of getting frustrated, view losses as a learning opportunity. Don't revenge trade. Trying to make back the money you just lost usually ends in disaster. Instead, analyze what went wrong and adjust your strategy. Every loss is a chance to grow. Tip number 4, focus on the process, not the profit. Many beginners are obsessed with making money, but seasoned traders know that consistency in the process leads to long-term profitability. Whether it's sticking to your trading plan, following risk management rules, or reviewing your trades in a journal, focus on the habits that make you a disciplined trader. Tip 5, risk management is key. You'll often hear that Forex trading is risky, but the truth is, it only becomes risky when you fail to manage it. Proper risk management means only risking a small portion of your account on any single trade, usually no more than 1 to 2%. This way, even if you lose, your account remains protected. To wrap up, Forex trading psychology is all about mastering yourself before mastering the markets. Stay calm, be patient, accept losses, focus on the process, manage your risk, and always review your trades. If you can get your mindset right, the rest will follow. If you found this video helpful, be sure to like, comment, and subscribe for more trading tips. Let me know in the comments what psychology tips you found useful, or if there's a topic you'd like to see next. Thanks for watching, and remember, in Forex, mindset is everything.